Hello everyone. Today we dive into the intriguing world of dividends. We're going to learn how to build a dividend portfolio. So what is a dividend? It's a portion of a company's earnings that's paid out to shareholders. These payments can provide a steady stream of income, in addition to any potential profits from selling your shares at a higher price than you bought them. Now, why is having a dividend portfolio important? Well, it's a strategic way to generate passive income. By owning a collection of dividend-paying stocks, you're essentially creating a flow of cash that comes in regularly, like a paycheck. It's a form of financial independence, as it doesn't require you to actively work for the money. And remember, dividends are not just for the wealthy. Anyone can start building a dividend portfolio and reap the rewards over time. So if you're ready to start earning regular income from your investments, stay tuned. If you are enjoying this content and you do not want to miss future videos filled with even more tips, tricks, and inspiration, hit that subscribe button now to stay tuned with us, and remember to comment and share. Now, to build a dividend portfolio, we first need to understand what dividend stocks are. Dividend stocks are essentially shares in a company that pays out a portion of its earnings to shareholders on a regular basis. Think of these payments as a way for companies to share their success with those who have invested in them. These payouts, known as dividends, can be a significant source of income for investors and are typically issued in cash, though sometimes they can come in the form of additional shares of stock. So, how do dividend stocks work? When a company earns a profit, the board of directors has a choice. They can reinvest those earnings back into the company for growth, or they can distribute a portion of the profit to shareholders as dividends. It's a delicate balancing act. On one hand, reinvesting profits can lead to greater future earnings. On the other, issuing dividends can attract investors, which can boost the company's stock price. Now, why are dividend stocks important for building a dividend portfolio? Well, they offer a steady stream of income, which can be especially attractive during market downturns when stock prices may fall. Plus, companies that regularly pay dividends tend to be more financially stable and less volatile than those that don't. This makes them a safer choice for investors. There are numerous benefits to owning dividend stocks. Firstly, they provide a consistent income stream, which can be particularly beneficial for retirees or others who rely on their investments for income. Secondly, dividend payments can serve as a cushion during market downturns, softening the blow of any potential losses. Lastly, they offer the potential for capital appreciation. As a company's earnings grow, so too can its stock price and dividend payments. With a clear understanding of dividend stocks, we're now ready to start building our dividend portfolio. Choosing the right dividend stocks is a critical step in building your dividend portfolio. Now you may wonder, how do we go about picking these stocks? Well, there are several factors to consider. First and foremost, we have the dividend yield. This is a financial ratio that shows how much a company pays out in dividends each year relative to its stock price. In simpler terms, it's the annual return on your investment expressed as a percentage. But remember, a high dividend yield isn't always a good thing. It could be a sign that the company's stock price has fallen, which might indicate problems. Next, we look at the payout ratio. This is the percentage of a company's earnings that it pays out as dividends. A low payout ratio could mean the company has plenty of room to increase its dividends in the future. However, a high payout ratio might indicate that the company is returning most of its earnings to shareholders, leaving less for reinvestment or for buffering against future earnings declines. Now let's talk about the company's financial health. A financially healthy company is more likely to sustain and grow its dividends over time. Look for companies with strong balance sheets, steady cash flows, and a history of profitability. It's also a good idea to consider the company's growth prospects. Companies in industries with strong growth potential are more likely to increase their dividends in the future. And don't forget about the importance of diversification. Don't put all your eggs in one basket. Spread your investments across different sectors to reduce risk. Last but definitely not least, remember to consider your own investment goals and risk tolerance. Dividend investing is not a one-size-fits-all strategy. What works for one investor might not work for another. By carefully selecting your dividend stocks, you put yourself in a position to earn a steady income. So take your time, do your homework, and choose wisely. Your future self will thank you. Diversification is a key strategy when building your dividend portfolio. Now, if you're wondering why, let's delve into that. Diversification, in a nutshell, is about not putting all your eggs in one basket. It's a strategy used to spread risk. In the context of a dividend portfolio, it means investing in dividend-paying stocks across a variety of sectors and industries. So, why is diversification important? Well, it's fairly simple. Different sectors and industries react differently to economic changes. For instance, during an economic downturn, defensive sectors like utilities or consumer staples might hold up better than cyclical sectors like technology or industrials. By having a diversified portfolio, you can cushion the impact of any single sector performing poorly. But how does one go about diversifying their dividend portfolio? It's not just about randomly selecting stocks from different sectors. It's about careful selection based on the company's financial health, dividend history, and growth prospects. Let's say you've done your research and picked a few strong, dividend-paying stocks from the technology sector. It's tempting to stop there, especially if the sector is booming, but remember, diversification is key. So you'd also want to invest in other sectors like healthcare, utilities, or consumer staples. Now, while diversifying, it's also important to consider the dividend yield and growth. High-yield stocks might be attractive, but they also come with higher risks. On the other hand, stocks with lower yields but consistent dividend growth can offer stability and potential for income growth over time. And it's not just about sectors. You might also want to consider geographical diversification. Investing in dividend-paying stocks from different countries can potentially offer additional protection against economic downturns in any one country. So, as you can see, diversifying your dividend portfolio is more than just a risk management strategy. It's about maximizing your income potential while also ensuring stability. Diversification not only increases your potential for income, but also reduces risk. And that, folks, is the essence of a well-diversified dividend portfolio. Reinvesting dividends is a powerful strategy that can significantly boost your income over time. Now let's delve into this. What exactly is dividend reinvestment and how does it contribute to the growth of your portfolio? Imagine a tree. This tree represents your dividend portfolio. The fruits it bears are the dividends. Now you could simply pluck these fruits and enjoy them, which would be akin to taking your dividends as cash. However, there is another option. You could take these fruits, plant them, and grow more trees. This is the essence of dividend reinvestment. You're taking your dividends, and instead of pocketing the cash, you're buying more shares in the company. You see, every time you reinvest your dividends, you increase the number of shares you own. And as you own more shares, you receive more dividends. This creates a snowball effect where your dividends and portfolio grow larger and larger over time. Think about it this way. If you have 100 shares in a company and they pay a dividend of $1 per share, you'll receive $100. Now, if you reinvest those dividends and buy more shares, you might have, say, 105 shares. The next time dividends are paid, you'll receive $105 instead of $100. This might not seem like a big difference at first, but over time, and with the magic of compounding, it can really add up. The beauty of reinvesting dividends is that it's often automatic and free. Many companies and brokerages offer dividend reinvestment plans, often called DRIPs, where your dividends are automatically used to buy more shares and often without any transaction fees. Remember, the goal of building a dividend portfolio is not just about generating income today, but also about growing your income for the future. By reinvesting your dividends, you leverage the power of compounding to grow your portfolio and your income. So, there you have it. A step-by-step guide on how to build your dividend portfolio. We've journeyed together through understanding what dividend stocks are and their potential to generate consistent income. We've delved into the art of choosing the right dividend stocks, weighing the pros and cons, and analyzing the financial health of companies. We've explored the importance of diversifying your portfolio, spreading your investments across different sectors to mitigate risk. And finally, we've discussed the power of reinvesting dividends, a strategy that can compound your earnings over time. Remember, building a successful dividend portfolio doesn't happen overnight. It requires patience, research, and a commitment to long-term investing. But with the right approach, you can create a reliable stream of income that helps you achieve your financial goals. Don't forget to subscribe, like, and share this video. Your support helps us create more content like this. Until next time, happy investing.